Roundtable, sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, Israel strikes back. Tensions in the Middle East escalating after Israel carried out limited strikes in Iran, responding to last weekend's flurry of missiles and drones. I'll ask retired U.S. Navy Admiral Michael Rogers what happens next. Then, tax refunds are on the way. Many Americans feel the urge to splurge with their newfound money. But here at Barron's, we're taking a look at the best ways to spend and invest your return. And later, shocking CEO salaries, a look at the top paid executives and how their raises stack up against yours. But we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Andrew Berry, and Elizabeth O'Brien. So, Ben, there were not many happy ports in the storm this past week. The entire market, except for maybe 3 points on the Dow, was in the red.
Yeah, it was a really awful week with the S&P 500 dropping 3%. That was its worst week since 2023. It also fell all 5 days of the week. That was the first time that's happened since 2020. There was really a massive sell-off in tech, with the NASDAQ finishing down 5.5%. And it felt by the end of the week like it was really just a risk-off move, that people were just unloading what had worked. We're getting out of it, and it didn't. I mean, it started off the week with fears about the Fed and not cutting rates and geopolitical fears, but by the end of the week, it was just like, we just need to sell.
And for those who might have forgotten, 2020 was a pretty bad year for a few months there in the market.
That was tough.
So one of the things that normally happens when you get geopolitical fears, stocks selling off, is you get a respite in the bond market and bonds rally. That didn't happen this time.
No, it was interesting to see that the market tried to rally on Thursday, and what ended that rally was the 2-year yield hitting 5%. And that was really a sign to investors that rates are going to be higher for longer, that the Fed, which is due to make its interest rate decisions on May 1st, we know that it's not going to do a rate cut then, but we were hoping that it was going to do a rate cut maybe in June. Well, that is looking like it's really not going to happen, and who knows if we'll even get a rate cut this year. And that has been a problem for the market.
Well, to answer that question on who knows whether we'll get a rate cut this year, we've got 2 data points next week that could give a little bit of an indication.
That's right. We're going to get our first reading of first quarter GDP. The Atlanta Fed GDP Now indicator, it's putting it around 2.9%, so pretty hot economy right now. The other thing we're going to get is PCE, and the PCE gives the Fed its favorite inflation indicator. It's supposed to actually, for the core, come down a little bit to 2.7% year over year from 2.8% year over year. If these numbers come in a fairly benign fashion, I think you could see this market rally. There's been a lot of risk off. People have dumped a lot of things. But if they come in hot and sort of confirm all these other numbers that we've had, it could be pretty tough out there.
Of course, it's a big earnings week next week, too. That will move markets. We've got a flurry of tech. I think 5 of the 7 magnificent 7 report next week, Elizabeth. We got an indication from Netflix, which had very strong numbers, but the stock still got clobbered.
Yeah, despite that, Netflix announced big subscriber growth, and that powered, better than expected earnings, although they said they were going to stop announcing subscriber growth, which seemed to unsettle the market because, of course, that is a key metric. And so that and weaker revenue guidance seemed to weigh on the shares.
So Tesla will also be reporting, or is reporting next week. That stock is down about 40% on the year. What do you expect there?
Yeah, that's right. Tesla's having a tough time. It's one of the worst performing stocks in the S&P 500. They're just having trouble selling cars. And so investors are going to be looking to Elon Musk for reassurance on, future sales prospects.
Meanwhile, Elon Musk will be looking to his shareholders to approve a $45 billion pay package. That'll be interesting. Yeah. And it looks like he's probably going to get it. Other companies reporting next week include Microsoft, Alphabet, Amazon, and also Meta. What are you watching?
Yeah, there's a lot going on. Microsoft, of course, is the biggest company in the world right now. So the big question is it going to, can it maintain the earnings momentum that got it there? Investors are also going to be looking for an update on the uptake of its new Copilot AI software. And Meta, we're also taking a look at,
What's the news there?
Well, Meta is up about 35% for the year. There's some concerns that costs for AI will crimp margins. And speaking of AI, just this past week, the company launched a new AI chat box, Meta AI. So it's really with this new development going head to head with chatbox with OpenAI, Google, and Microsoft.
The AI wars. Andrew, the only good news is left for you. The one shiny thing in the market was gold.
Yeah, I mean, the metal gold is one of the better asset classes this year. It's up 15%. It hit $2,400 an ounce on. Why it's higher is a little bit tougher to determine. Normally, when you have higher market interest rates in the U.S., like you've had this year, gold goes lower, but it's going higher. You've also had redemptions from some of the big U.S. Gold ETFs, like the Spider Gold Trust, the GLD. What seems to be happening is you're seeing stronger demand from outside the United States. Central banks are buying it, including China, as well as Asian investors. And maybe people may be sensing that there could be long-term inflation problems in the U.S.
Often when gold goes up a little, the miners go up a lot. That's not happening.
Yeah, I mean, the miners have continued to be a disappointment this year. The GDX, which is one of the big ETFs, is up about 10%, lagging the gold itself. And two of the big miners, Barrick and Newmont, are actually in the red this year. There have been some company-specific problems there, including a dividend cut at Newmont. But the stocks, though, are looking pretty inexpensive right now historically.
If you want access, how do you recommend people get it?
Well, you can buy the gold ETFs, including the GLD. You can also buy physical gold. Costco, for instance, sells it. There are also U.S. gold coins you can buy, and the mining stocks themselves, which including the GDX and some of the big miners, including Agnico, Eagle, Barrick, and Newmont.
Alrighty, I will point out that gold is still below its 1980 high if you adjust for inflation, but some people like it in a storm. Thanks, guys. Israel is fighting back. The country responding to Iran's aggression with a missile strike of its own this week. Retired U.S. Navy Commander Admiral Michael Rogers tell us what comes next right after this. Israel launching a limited strike on Iran this week, hitting a military base. Senior Iranian officials reportedly say Tehran has no immediate plans to retaliate. To help us understand the complicated dynamics roiling the Middle East, joining me now is retired U.S. Navy Commander Admiral Michael Rogers. Mike, great to have you on the show again. Thanks for doing this.
Great to be here. Thanks very much for the opportunity, Jack.
So let's start with Iran and Israel. The news is that they are shooting at each other, but what's interesting is actually how restrained their actions have been. Why are they pulling punches? Do you think that they've actually opened lines of communication?
So it appears that each side feels they need to, quote, use a strike as a method of sending a message to the other. And that message, I believe, is one of deterrence. Hey, you need to stop escalating. I believe both Iran and Israel are of the view that the other has been engaged in escalatory actions. And so each has felt they needed to respond with a strike. Let's hope that the conclusion in this latest round is message sent, message received, and let's not respond in kind any further.
Speaking of Iran, you helped negotiate the deal that put Iran's nuclear ambitions on hold. Does this recent shooting of missiles at Israel suggest that maybe they're closer to a bomb now that that deal has been abandoned?
I don't see that connection between this Israeli strike, but I will say I think Israel selected the target area of Isfahan in Iran in no small part because that area has several significant sites associated with the Iran nuclear program, even though those sites themselves do not appear to have been the focus or the target of this Israeli action against Iran.
Interesting. I want to switch to the other front in Israel wars. You were called in by the IDF, the Israeli Defense Forces, to give them some advice. What did you tell them?
Well, look, I was asked to do an independent assessment as part of a group of retired American military leaders about how we would assess the effectiveness, if you will, of the IDF activities in Gaza. And what I saw was a military, very professional, that was attempting to minimize casualties. But I also saw a military that perhaps needed to step back and think about what was it doing to ensure the security and safety of the citizens of Gaza now that Israel had removed the previous mechanisms of security and stability in the form of Hamas, since it also governed Gaza, that the importance of humanitarian aid and ensuring that aid not only entered Gaza, but made it to the citizens of Gaza who need it wherever they were located. And then trying to support that international effort that's trying to ensure the safety, the well-being, and the sanitation and health, if you will, of these displaced Palestinian citizens in Gaza who, as a result of Israel's conflict with Hamas, have been forced to leave their homes.
It's like the old Colin Powell line, you break it, you own it. Now Israel kind of owns it. I want to pivot to Ukraine, where it is widely reported that without some help from the West, they're going to have a lot of trouble defending themselves during the summer fighting season. What's at stake for the U.S., for our Western allies, if Russia is able to actually annex, I don't know, a third of Ukraine?
Right. So three things come to mind to me. Number one, it would send a signal to Putin that he could continue to pursue these kinds of aggressive actions, including the use of armed force against neighboring nations. Remember, he has invaded Ukraine twice. He had previously invaded the neighboring nation of Georgia on the other side of the Black Sea. So he has shown a willingness to use force and to disregard the sovereign rights of his neighboring nations. I think a defeat and a U.S. inability, if you will, to provide the support we promised to Ukraine, number one, emboldens Putin. Number two, I think it also sends a broad message to others around the world that perhaps you can get away with, these kinds of acts of invasion, or you, if you will, or the use of force against international law. Think about China and Taiwan as an example. That's not the message that we want the rest of the world to pick up. And then I think, thirdly, I think a lot of other nations around the world would be looking at this scenario and saying to themselves, as they consider their own national security choices, should I be creating a long-term partnership or relationship with the Americans or Western Europe if they seem to be unwilling or unable to execute their promises over time? Is that the kind of nation I want to partner with? Those are the three things that really come to mind for me.
Thank you. Certainly important. Before I let you go, we're almost out of time, but I want to ask you, given your NSA experience, about some comments by FBI Director Christopher Wray. He said the Chinese hackers have gained access to U.S. infrastructure and are waiting for, quote, just the right moment to deal a devastating blow. That's kind of scary. How big a threat do you think that is?
Well, it shows that we're seeing a significant change in China's calculus with respect to the amount of risk they are willing to run vis-a-vis cyber activity against the United States. And what FBI Director Wray is trying to point out is with what the government is calling Volt Typhoon, where the government found Chinese uploading of destructive software in components of the United States electrical grid. I mean, that is really worrisome and suggests that China's decided it's in their best interest to be much more aggressive against our infrastructure in the sense that they are preparing, it appears, to potentially disable it at the time and place of their choosing.
It is a scary world. Thank you for your service helping us defend it, and thanks for explaining it to us today.
No, thank you for the opportunity, Jack.
Admiral Mike Rogers. Turn your tax refund into an investment. How an influx of cash could help you get your finances in order and build new wealth. That's next. 67 million Americans have gotten tax refunds, and checks are still going out. It's tempting to spend that newfound cash, but the money is a great opportunity to get your finances in order and even make some smart investments. Elizabeth, how much cash are we talking about here?
Yeah, the average refund this year is about $3,000. And if you're wondering where your refund is, as I certainly am, you can go to irs.gov and check the Where's My Refund tool.
Alrighty, so Dow Jones this past week launched Smart Money, a free personal finance resource that is part of an ongoing financial literacy initiative. So in the spirit of financial literacy, Elizabeth, what are the smart money moves to make?
Yeah, well, if you don't have any savings in the bank, this is a great opportunity to get that started. You can still get interest rates of between 4 and 5% at, online-only high-yield savings accounts. So that's a great place to start. Now, you might think, oh, well, I'll just put all that money to start toward my credit card debt. But if you don't have any as a cash cushion and an unexpected expense comes up, you're just going to perpetuate that cycle of debt and interest. So put a little money in the bank, maybe $500 or so, and then you can tackle that credit card debt, put it toward your credit card debt. Now, if you have those basics set, you can move on to, it's a great opportunity to make it a contribution to your IRA, put in some money for retirement. And if you have a health savings account, you could also funnel some money there. And also a 529 college savings account. A lot of good places to put your refund to work.
I might take a little issue with not paying off the credit card debt. That, to me, is like a 17% money market fund. I say put everything in there. If you have to borrow against your card later, go ahead and do so. But look, our viewers are all checking all these boxes long ago. They want to know what else to do with their money. Any investment ideas from you guys?
I'd say right now I like laggard sectors in the market, and I'd point to the small cap sector of the U.S. stock market as well as emerging market stocks. For instance, in the small cap area, the Russell 2000 index is down down about 4% this year. It's about 10 percentage points behind the S&P 500. You can buy ETFs on the Russell 2000 as well as the S&P small cap index. Emerging markets have been lagging for a decade. They're barely higher in the last decade, and there are a number of ETFs and mutual funds, including the IEMG ETF and the Vanguard VWO ETF now.
And for people who are worried about exposure to China, you can go with the EMXC ETF, so that's emerging markets ex China.
Right, and they yield about 2 or 3%, and they're very much out of favor, particularly right now, the emerging markets.
That's about time for a turnaround. Ben, what would you recommend?
Well, I'm going to start with gold. I've been a fan of it for a while now. This run is interesting. We're hitting new highs, maybe not for inflation, but they are hitting new highs. And right now, you can get with that average tax refund, gold is $2,400 an ounce. You can actually get an ounce for less than the average refund. So that's not a bad place to be. The other thing I like is cash. You mentioned those 5% yields that are out there. You can get the high yield account. You go into a money market fund. You can even just go to Treasury Direct and buy bills yourself. And that way, as Andrew is fond of telling us, you don't have to pay state taxes on that. And you can even go into an ETF like BIL. It's the Spider Bloomberg 1 to 3 month T-bill ETF. And that's just a very simple way to do it. And in a volatile market, it's not a bad idea to have a little bit of cash. If the market falls, you can put it to work in the market.
I'm going to throw out a quick idea from an advisor in Colorado Springs, Alan Roth. He loves the inflation-protected annuity-like returns of annuities, but he doesn't like annuities. So he builds his own. And his idea is you got $10,000, you put $6,700 in a 10-year TIPS, IBIJ is an easy ETF way to do that. And you put the rest in a stock market index like SPY or VTI. And by his calculation, if the market falls by 50% over 10 years, highly unlikely, you'd still keep up with inflation. If you get a more normal stock-like return, that's an 8% after inflation return on that investment, which is kind of interesting. Elizabeth, your market ideas.
I'm thinking maybe value stocks. They've been under a cloud for the better part of a decade, but some say there might be their time to shine. And just because the S&P 500 is up so much, I think for diversification purposes, it helps to sort of throw some money to an unloved part of the market. Yeah,
that's a good idea. But look, enough financial broccoli. You get that check, Elizabeth, splurge a little bit. What would you buy?
Treat yourself, 5% or something. It's your hard-earned money coming back to you. I need a new work bag, a new purse for work, so I'm going to get that.
Quick ideas?
I'd say I'm a big fan of Broadway, and there's a hot new musical that's opening soon called Stereophonic, and I'm eager to see that.
And with prices on Broadway, you need that refund. Ben?
And I like to play around with my synthesizers at home, and so I'd go and grab myself a little synthesizer module to plop into my case and make some noise.
I'm going to buy a plane ticket somewhere fun. All righty. Elizabeth and Ben, meanwhile, have some investment ideas, and Andrew will give us a look into the lucrative world of CEO salaries. Stay right there. Andrew, it's proxy season, which means companies have to reveal those enormous pay packages for CEOs. Who got the biggest bucks?
Well, Barron's did a story on the pay packages based on a study by Equilar, which is a pay consulting firm, and CEO salaries last year up over 11% to $23.7 million, and it's a big number. And the highest paid CEO last year was Hock Tan of Broadcom. He got paid about $160 million, mostly in stock. People complain about CEO pay, and that a lot of that's justified. But as far as Broadcom is concerned, Tan has delivered. The stock's up fivefold in the past 5 years. Other notables include, Tim Cook of Apple, who got paid over $60 million. The stock didn't do very well, though. And Satya Nadella of Microsoft got paid nearly $50 million, but that's been a big winner.
What about those who maybe there wasn't so much correlation between performance and pay?
Yeah, but one notable on the low end, of course, is Warren Buffett of Berkshire Hathaway. He just gets paid only about $100,000 a year, and that pay has been unchanged for about 25 years. He's talked about the dynamics in corporate boardrooms that lead to such big pay packages and big increases. He says that corporate board members just don't want to rock the boat. They don't want to anger the CEO, and the pay consultants that the CEOs bring in are rarely going to recommend lower pay.
Yeah, he says if you want to get invited on a board, making waves at the other boards you're on is not really going to help you.
Exactly.
Let's go to actionable ideas. Elizabeth, what do you have for us?
Yeah, so any day now, the Department of Labor is expected to announce a new rule holding some financial advisors to a higher standard. Now, you might understandably assume that your financial advisor is acting in your best interest, but that's not necessarily the case across the board. So I have a word for you. It's fiduciary. If you are considering hiring a financial advisor, ask, are you a fiduciary? And if they say yes, that means they're duty-bound to put your interests ahead of their own.
It's like a doctor or a lawyer.
Exactly. And it should be a yes, by the way. It shouldn't be a no, but blah, 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 blah. It's a yes or no. Yeah.
I agree with that. Ben, what's your advice?
I'm looking at United Rentals. This is a stock that they're a company that rents equipment, construction equipment. They have done very well this year, but like everything else that has done well this year, it got really beaten down this week. And this is actually a good time to go look for some quality stocks like United Rentals. And I think that right now it's looking pretty interesting.
Not a tech name.
Not a tech name.
Interesting. Thanks, Ben. Thanks, guys. To read more, check out this week's edition at barrons.com. And that's all for us. We'll see you next week on Barron's Roundtable.